Welcome back to this week's market drama. We'll start with the stock market. The S&P was up 1.6% last week. That's 9% year to date. If you double click as to the drivers, cyclical stocks are up 14% year to date. These are the stocks that got hit the worst last year. Now, what's driving that stock movement? Well, for one, the idea of a severe recession, right? The probability looks lower. And there's one main data point that came in last week that supports that theory, which is the January jobs report came in much better than expected, adding 517,000 jobs. The consensus expectation was for 185,000, right? So just blew it out of the water. Now, there's a lot of seasonality to that number. Nonetheless, the unemployment rate is now at 3.4%, which is the first time we've seen that since May of 1969. Right? So hard to see a severe recession when you have such strong employment data. The other data point that's worth highlighting is that the FOMC happened, the meeting in which the Federal Reserve raised interest rates 25 basis points. That was expected. What wasn't expected is that in the press conference, the Fed chairman used the word disinflation a number of times to point out that, yes, the Fed now acknowledges that inflation is coming down from very high levels. In prior meetings, they had not acknowledged that. They said, we'll have to wait and see. Hey, one data point is not enough, etc. So the market loved it. As soon as he started using that type of language, the market rallied. Why? We've talked about this every week. There's a huge disconnect. The Fed's telling us they're going to keep interest rates at 5 or higher this year. The market's pricing that they're going to lower it. So by the Fed acknowledging that there's disinflation, the market's like, I gotcha. All right, you're going to actually lower it later this year. Now, the Fed denied that. There was Q&A. They said, look, we're not looking to lower interest rates this year. Nonetheless, this gap will continue until either the Fed decides to say, yeah, the market was right, we're going to lower interest rates, or the data supports the Fed's view, which is, hey, look, way too early to lower interest rates. Yes, inflation is coming down. We don't think we're out of the woods yet when it comes to inflation. What to look for this week? Number of earnings reports. We have Disney, Chipotle, DuPont, Pepsi and Company, and a number more that will continue to paint a picture of earnings not doing well, right? We probably will see year-over-year drop of 5%, maybe even 6% year-over-year earnings growth. Nonetheless, the expectations were even worse, right? So stocks are also rallying in the back of that. The other thing worth keeping an eye on is on Tuesday, the Federal Reserve Chairman Powell will have remarks before the Economic Club of Washington. So we'll look closely to see further comments about disinflation, further comments about their forecasts for the economy this year. All right, that's it for this week. Stay tuned for next week. Take care.